Hello viewers. United Parcel Service Inc., YSE UPS, or just UPS colloquially, is a transportation and delivery, distribution and logistics giant headquartered in Seattle, WA. It was founded in 1907. It's strange to imagine that my great-grandparents could have been zero-day investors in a company I'm writing coverage on now in 2024. Its primary competitor in the private space is the Federal Express Inc., FDX, with its public competitor being the US Postal Service and other sovereign delivery services. Foreign services like DHL, OTCPK, DHLGY also compete with UPS, both domestically and internationally. Since its IPO at the turn of the century, UPS has regularly outperformed the market over long periods of time, with some exceptions. Until very recently, when a massive divergence happened in July of last year. This was primarily due to declining revenue. UPS still has a rich valuation. Despite the steep drop in price, we have actually seen a rise in price to earnings, now almost double what it was at for most of 2022 and 2023. This is a very bad sign for UPS because it means that as it's getting cheaper in price, it's not actually getting any cheaper as a stock. In fact, it's more expensive now than it was when the price was higher. Compare UPS to its primary rivals, and we see that it's actually more expensive across price to earnings, price to sales, and price to book. This makes UPS unattractive from a value standpoint and highlights its key weakness as a falling stock that isn't improving. That may be changing, however. What's the good part? I tried very hard to find upside in UPS, and other than the narrative of management turning it around, they have a quote from management on the front page of their Investors Relations page. This volume growth they are mentioning is a key metric for UPS. This is a reflection of how much business they are doing. Both small and large package volume has been low, but management has said that it is turning around. UPS is still profitable. Income, despite also being on the downtrend, is still positive. The above chart shows how UPS is now making half of what it was in 2022 after expenses, which have been falling alongside revenue. This corroborates the narrative that volume is what is hurting UPS, since we can see that they have been able to reduce expenses as their revenue falls. While expenses are on a flatter slope, this is primarily due to UPS's need to be able to pivot back to large volume business if volume picks back up. Little else seems to be changing, margins are still falling. The logistics industry has faced criticism about becoming a race to the bottom. UPS seems to be gravitating toward this, with massive drop-offs in margins in the last year. Following this, we have seen consistently lower return on equity figures year over year for the last few years. Now, UPS is returning figures lower than they saw during the COVID-19 pandemic that saw a very sharp decline in ROE initially. Worse yet is the fact that UPS is now below that low point in 2021 on a slow grind. Instead of some large drop-off due to an external trigger, this looks like UPS is bleeding out. Will management pull it off? I think it is unlikely that UPS will recover quickly, but I do believe in its ability to weather downtrends. That being said, survival doesn't make UPS a buy. I believe that UPS still has some adjusting to go to fall in line with its industry peers, and prices could fall even further. To this end, I am giving UPS a hold rating, as I am eager to see what the next earnings report holds. That report will give us great insight into whether these trends continue or not. If UPS is able to grow its revenue, even if it is just enough to break the trend, then it may enter buy territory to benefit from the return to grace and mean reversion back toward the progress that large cap stocks have made in the last few years. If UPS is not able to grow its revenue and we see continued decline, then I will keep my hold rating and stay away from UPS for now. It may become stagnant, which I see as the most likely scenario if the next report is poor. There is little that management can do to stop UPS's exposure to the business cycle. As the US deals with fleeting, but still present inflation and increased rates, businesses will be doing less volume with UPS. This volume is driving their revenue, and so the outlook for UPS may depend on your outlook on general macro. I believe that we are still in for a soft landing, as the Fed had become very dovish last month. Suitability-aggressive investors may take a chance on UPS's recover, but know that it is speculation as of now, as the trend is still down both fundamentally and technically. Speculators and aggressive equity investors are advised to limit UPS to no more than 2% of their equities portfolio. Conservative investors may consider UPS but should be wary of its volatility and potential for continued loss. To this end, I recommend no more than 1% exposure to UPS in an equities portfolio. Conclusion: United Parcel Service Inc., UPS, has had a very poor showing over the last year, and it doesn't seem to be ending anytime soon based on current trends in revenue, earnings, and profit margins. UPS, to succeed and reverse its stock price crash, must increase its volume back up to 2022 levels. This partially is a result of the credit cycle and higher rates leading to lower shipping volumes. However, UPS can prove itself at its next earnings call. I will be eager to see if they are able to buck the current trends and pivot back toward growth. Until then, they are a hold for me.